Welcome to Smart Money, brought to you by Daily Investor, South Africa's fastest growing investment publication. And with us today is Paul Theron, founder and chief executive officer of the active investment management firm Vestact. Believe it or not, he's engineer turned investment banker. He founded South Africa's first online stockbroker, Trailblazer, in 1996. And Vestact, which manages assets on behalf of its clients through segregated portfolios on the Johannesburg Stock Exchange and the New York Stock Exchange, followed in 2002. Over the last 20 years, Vestact's shown strong growth, and its model portfolio has achieved significantly better annual returns than the market. Paul, thanks so much for joining us today. So, a master's degree in engineering. Before we talk investing, let's take a step back into the 90s. You graduated as an engineer in energy studies. Are you glad that your calling took you down a different route? I mean, who knows? You could have been doing something at Eskom.
Yeah, I could have been the Minister of Electricity by now. No, I mean, it is a bit of an amusing career path, but yes, I did engineering at UCT and then I stayed on to do a master's. But remember, that was the early 1990s. South Africa was full of hope and enthusiasm for the future. And my specific area of study was energy policy, which was oil, gas, coal, and then also, yes, electricity. And we looked specifically at the program of using Eskom's excess capacity. I know it's hard to believe, to spread domestic reticulation. Obviously, what's happened since then has been a dire disappointment. But I then sort of transitioned from that because of the emergence of the internet as a business tool in the mid-90s, which created all sorts of entrepreneurial opportunities.
So talk us through that progress then, how you moved from the engineering world to that of the world of finance and ultimately landed in asset management.
Yeah, so exactly what happened is that I was working for a while after having worked in the sort of energy policy era in a corporate in the old Anglo-Val group, which at that point was being split into the mining and the industrial half. I worked there for about 2 years, during which time I saw enough of corporate life to know that I needed to get the heck out of there and run for my life. Because I always enjoyed being an entrepreneur, having my own boss, being involved with things. So basically, I looked around for some opportunities to start a business. And the most obvious ones at that time were anything to do with the internet, because it was just breaking globally as a tool to accelerate, business progress. And if you had the tech smarts, you could get in there with very little capital and get started. So we literally started, and by we, I mean myself and a few friends and associates, different internet businesses. One was an internet sports business, which we sold after a couple of years to the Mnet group, and it became the beginnings of the SuperSport website. And some of the guys that I worked with still run that business. Another was a business which did bulk emailing to people who were interested in email promotions. We actually shut that one down, which is a crying shame because MailChimp got sold for $20 billion, about 2 or 3 years ago. And then the third one was an internet stockbroking business. And we literally wandered down to the stock exchange on Diagonal Street and said to some old style brokers, we want to start an internet interface. And that's the business you referred to earlier, which became Trailblazer, which was an absolute disaster. We were briefly listed on the stock exchange itself. But we had Sanlam as a shareholder. The dot-com meltdown happened. Sanlam wanted to get out. That business was delisted and shut down. And that's when I started Vestact. So, I basically learned all of the errors one can make in small cap, building of businesses early on, and then worked out how to do it properly, which is what I did with Vestact, which is now 20 years old.
And starting an asset management firm is no easy feat, right? So what were the biggest challenges you came up against when you founded Vestact 20 years ago, even with, those lessons sitting in your arsenal?
So I knew how to do the technology, and I knew we wanted to be an asset advisor, not a member firm. I knew that we wanted to, use the internet to communicate with people, build a good database from the beginning. The problem to start with was we had no clients. I was also subject to a restraint in terms of leaving the previous firm. So we literally just, kind of bootstrapped it and built from client to client, built the model. We started off providing JSE portfolios, and then in 2005, we added portfolios in New York through an important relationship we had with a New York-based broker. So that got a massive, massive boost, of course, when Jacob Zuma was elected Chief Marketing Officer of Vestact, President of the country. Everyone was like, my God, we need to externalize our investments. And that gave it a big push. So we now have about 7.5 billion rands under management, but 95% plus of that is actually in dollars in New York. So it's actual retail individuals, South Africans who have money there. And again, the obvious reasons for doing that are that, that market's been very good. It's been very strong. The tech stocks in particular have done well. But it also gives people asset protection as the rand has weakened over time, and as people feel a little bit anxious about being trapped in rands with their properties and their businesses and everything else. To externalize investments makes sense.
And there you give us a sense of what your investment strategy or your principles were back then, Paul. What's changed?
Not a lot has changed, really. When we started the business, in that period, 2003, 4, 5, there was still the aftermath of the massive Chinese industrialization, which led to that super cycle you'll remember in the commodities market. So we invested at that time in companies like Caterpillar, BHP Billiton, General Electric, global companies that were involved with that sort of thing. That investment theme sort of ran its course as the decade wore on, because China's industrialization pace inevitably softened. We were always interested in technology stocks. So I had, with my engineering background, always been a big believer in the internet and the application of the internet as a business model. So we got in early into stocks like Google, aka Alphabet. Annoys me like hell that they have that confusion about the name, but let's just call it Google. Apple. We were early investors in Apple. We were early investors in stocks like Visa, which is not really a tech play in its first instance, but it's about, electronic payments. We were early investors in NVIDIA. We were early investors in Tesla. Now, you don't have to pick too many of those right to do well. It's been a bit up and down. We've had our moments. The global financial crisis of 08-09 was a really, really tough time for anyone in the markets.
Yeah. But
since then, we've done well. We've also lately become involved quite closely with healthcare investments. So our big three sectors are tech, healthcare, and then select consumer stocks as well. And we avoid everything else.
Paul, what you're emphatic about is the fact that you were early investors. So if I gave you R1 million today, where would you put it to work?
Yeah, that's a great question, because remember, if you go back 20 years and you look at what the world's largest and most impressive companies back then were, and then you compare that list to which the top 20 are now, there are significant differences. So the question, of course, that's prompted is, what is the list going to look like in 20 years' time? Because those are the companies you want to buy now. I would start by answering that question by saying that there's a fair chance that some of the really big companies that are on the list now will still be there then. So it's a bad idea to dismiss your market leaders now and buy a bunch of future hero companies that you think could change the world, because that often leads you to sort of bleeding edge investments, which may succeed or may not. I think the most important thing when benefiting from long-term investment takes or stakes in companies is to pick companies that have the ability to deliver sustained top-line growth. In other words, sustained revenue growth. So I think that means you've got to go with what's doing well now, provided they still have legs. So I would argue a company like Apple still has legs, a company like Visa still has legs, a company like Nike still has legs. So I think you want to be there, but then you've got to blend into your portfolios companies that are involved in things like, genetic medicine and, streaming media, companies that are big already, but which may be substantially larger in years to come. And I think also then have to specifically avoid companies that are in industries which are in their sunset phase. So you'll never hear me leading towards or talking clients into buying, shares of tobacco companies or oil and gas companies or, those kinds of things.
Okay, got you. And I'd imagine that forms bulk of what you tell clients who are worried about temporary losses, right? This year, though, many are sighing a breath of relief. It's been a stronger start. What's your outlook for the rest of the year? And are you still bullish on those mega tech companies? I would imagine so, given what you've just said.
Yeah. Look, this last year, 2022, was concerning because obviously in 2021, in the aftermath of COVID and the big shift to working from home and the massive investment by corporates across the board in expanded tech infrastructure to support that, gave everybody the idea that 5 years worth of growth was pulled back into 2021 and the sky was the limit. Everyone was factoring incredible earnings growth for these big tech companies, and interest rates were basically at zero, where they'd been during the global financial crisis. They picked up a bit and then they were taken back to zero during the COVID debacle. So that created a particular valuation paradigm where you could almost do no wrong. Anything that had exciting prospects was getting marked up week after week, month after month. I think 2022 was a big sobering up because the inflation problem reared its ugly head. The Fed raised rates from zilch to 4% in the matter of months, which is more dramatic than has ever been seen before. And lots of the shift that we saw in that COVID period kind of went away. I mean, e-commerce sales went back to trend. Some of the infrastructure spending on technology went back to trend. And I think many of us tech optimists felt that the tech sector companies would retain more of that market share and, a generational shift. And that hasn't really been the case. But for the record, I think that pretty soon we're going to find the inflation numbers go back by themselves because inflation is always a measurement of, this year's prices against next year's prices. So to sustain the rates of inflation where they've been, we would need, further increases in prices, which I don't think we'll see. So my own default view is that inflation will subside. The Fed will quite soon indicate that it's done enough, if not too much. And then the sense of optimism about humanity's future and the roaring 20s is going to come back. So we haven't made any significant portfolio adjustments. And I can tell you, we've taken some pretty heavy hits in a couple of those more optimistic tech plays. Companies like Illumina, PayPal, Netflix, and others have all been absolutely hammered. Some of them have recovered quite nicely. So we'll have to wait and see. You can't completely fall in love with your companies that you own through thick and thin, but it does pay to be patient.
Well, you've proven that, right? Because through the cycles, Vestac's assets under management, like you said right at the top, has now exceeded 7 billion rand. And the fact that you achieved this growth with a very small group of portfolio and asset managers makes you pretty unique. On that note, Paul, what would you say is the key to achieving high levels of efficiency and productivity?
I think it's the application of technology in the business from the beginning. You're right. Our $360 odd million is not particularly enormous by, asset management standards. But many firms with similar assets under management have like over 100 employees. I don't know what they do. They've got a marketing lady and the marketing lady's got an assistant. They've got a office manager and he has an assistant too. They have offices in George and Pietermaritzburg and Polokwane. We don't have any of that stuff. We also don't spend money on any marketing. We don't go to golf days. We don't go to conferences. We don't do quarterly boozy lunches with our clients. All we do is sit in the office and read. So there are 4 professional staff and 2 support staff. And then there's an extensive, Oracle database, which keeps our messages going out to our clients, including the reporting on their portfolios, all that kind of thing. So the business was built lean to start with. And I think that's why it has done well, and why we're able to service our clients, off a relatively low cost base using an Oracle database that we built ourselves with one developer that is hosted on Amazon Web Services in Cape Town and does the job. But I think it's also a mindset. Some people have a mindset which is sort of large corporate. So they think you got to do a startup with, you got to burn your way through a couple of hundred, 1,000 rands a month just because you're in business. I don't think that's true at all. Also, as the boss and as the founder, you have to be prepared to do anything and everything, which includes, cleaning the office, building the customer relationships, doing the accounts, making sure that you don't waste any money while you get things proofed up.
Exactly. Well, lean, mean thinking and cleaning machine, I guess, is the key to business success. Let's wrap up on a more personal note. Paul, what's the best share investment you've ever made? The one which produced the best returns?
It's a good question. I mean, my own investments are in the same stuff that our clients own. And I might have gotten into some of them slightly earlier than others as an experiment in my own family accounts before then recommending them to clients. So I've certainly had massive 100-bagger gains on Tesla. It's been quite volatile lately, but I bought Tesla shares a few months after they were listed, and they then proceeded to do nothing for a good long time and then went to the moon. Netflix was also a very successful investment for me personally. We got involved with that one, myself and for clients, when they had a couple of million subscribers, and now they got 220 million subscribers. Another stock which I owned is an athleisure company called Lululemon Athletica, which has done well. But I would say the investment that I'm most proud of is the one in Visa, because Visa was, remember, owned by banks, and then it came to the market in about 2012, I think. It was listed, and we got everybody involved with that, and it delivered that top line growth. So that's also been a major, major winner. And having gotten into that one early and ridden them all the way, we've never sold, a share of those unless somebody needed the money for something else. So that's been a huge winner.
Well, Paul, onwards and upwards from here. Great speaking to you today.
Thanks, Alishia.